Vonnie Quinn in New York, in for Emily Chang. This is Bloomberg Technology. Coming up in the next hour, we're going to stay here until we finish. That assessment from Senate Majority Leader Mitch McConnell as Congress gets ready to vote on a nearly $900 billion stimulus plan attached to a $1.4 trillion measure to keep the government running. We'll have the latest. Plus, Tesla skids. Tesla among the biggest drags on the S&P 500 in its first day of trading in the benchmark. How does it affect the index as a whole? We'll dig in. And riding high, Peloton agrees to buy fitness equipment company Precor for $420 million to gain U.S. manufacturing capabilities and new expansion opportunities. We'll hear from Peloton President Bill Lynch. Those stories in moments, but first, U.S. stocks slumped today amid a new mutation of the coronavirus in the United Kingdom, a wave of lockdowns and of travel restrictions. Bloomberg's Abigail Doolittle has more on the market day.
Well, Vonnie, it certainly was a volatile market day because at the lows, we had the major averages at one point, at least that NASDAQ 100, those futures down about 3%. And that's actually true for the S&P 500, too, on those virus fears that you were talking about, the mutation in the UK really weighing on markets, the more severe lockdown there, and the fear that that could come here and, of course, slow global economic growth. So on that, we did have, again, the S&P 500 sharply lower on the open. On the close, though, only down about 0.4%. The NASDAQ 100 down a commensurate amount. So a bit of recovery as the buyers seem to find their footing. In terms of some of the top movers, you were talking about Tesla down about 7%. Sell the news action after the company was added to the S&P 500. That volatility, though, not coming as a big surprise to a lot of the experts. Options Insights, some of the experts that have joined us have suggested that you would see that sort of sell the news action for a stock that is up an astounding more than 700% on the year. AMD was another high flyer to be hit today. So investors really taking some profits. On the other hand, this year's defense, the Apples and Microsofts, the Alphabets of the world, those stocks were higher at the end of the day. And that's one reason we didn't have a huge sell-off. So a bit of a balance there, Vonnie. And then finally, last week, it's interesting. We have all this positive news around the vaccine. Pfizer's vaccine starting to go into distribution last week. Moderna's this week. Last week, both of these virus makers down sharply on the week, those declines extending into today. So it seems as though we have a bit more sell the news there. Will it carry through to the major averages? It did a little bit on the day, but not in a huge way.
Bloomberg's Abigail Doolittle, thank you so much for joining us and giving us that rundown on today in the markets. In Washington, meanwhile, lawmakers are poised to pass a stimulus package Monday night, tacked onto a government spending measure. Earlier, Bloomberg's David Weston caught up with Illinois Democrat Senator Dick Durbin. He gave a rundown on the bill.
There'll be a relief for millions of Americans by extending unemployment benefits, at least, I'm looking for the final language, 10 or 11 weeks. Also making almost $300 billion available in loans to businesses, which I think is going to mean survival for some of these businesses, literally. More money for the logistics of the vaccination campaign, help for the schools.
Well, with more on the stimulus, let's get now to Bloomberg's Eric Wasson. So we finally did come out with some legislative language this afternoon, Eric, 3,000 to 4,000 pages, in fact. Was there anything in there that we weren't anticipating? We know the broad outlines of what the House and Senate will be voting on.
It's actually even bigger than you mentioned. It's 5,593 pages to be exact. It's one of the biggest bills I think Congress has ever passed, if not the biggest. It's got this $900 billion stimulus bill. It's got $1.4 trillion regular government funding. We also have a bevy of tax breaks, energy legislation, everything from Sudan terrorism policy legislation to changing the way the government evaluates airplanes in the wake of the Boeing 737 MAX crisis. So this is a bill that's chock full, and lawmakers have very little time to evaluate this. In fact, they're going to have 1 hour of debate on the House before voting on it. So it's really an incredible piece of legislation when you look at it.
When are they voting exactly, Eric?
Well, they're going to have some procedural votes to set up the vote around 5, but we're expecting around 9 or 10 o'clock for it to pass the House and then go over to the Senate, where, they could move on it as quickly as 10:30 or so. So it's going to be, a tight situation there with the government funding lapsing at midnight. Now, of course, right at midnight, if the bill has not yet passed, it's not like everything just ceases and federal workers stop working. The White House Budget Office can delay an actual federal shutdown for several hours, and that's what I would expect would happen in this case, since this is pretty much a done deal.
Now, some representatives on both sides of the aisle in the House complaining that there isn't enough time to figure out exactly what's in here. Is there any danger that things are going to get passed that will be, undoable afterwards?
Well, Congress can always come and reverse itself, but as you saw with the 9-month delay on the stimulus, it's very hard to get consensus and to get people together to fix something. So there's going to be a back and forth. Congress could revisit the issue, but this is one way that lawmakers have found over time to really ram things through, is this last train leaving the station approach to package things together, and to get it through. So, for example, Mitch McConnell got in regulations to the horse racing industry. If you're an opponent of that, you would fight that on an individual basis and prevent it from getting passed on the Senate floor. It's hidden, deep in page 5,000 or so of this bill, and it's going to become law.
That's phenomenal. Eric, the pandemic relief portion of this is almost $900 million. We know basically that it's a $600 check for individuals and an extra $300 in unemployment insurance, for example, unemployment benefits. Will that be enough? Are lawmakers pushing for more after this particular slice of pandemic relief?
Well, Democrats are definitely looking for more. They say it'll be their top priority under the Biden administration to secure additional COVID relief. Nancy Pelosi telling reporters at a press conference last night it'll be easier with a Democratic president, even if there's a Republican Senate. But I think it's going to be a tough lift. We see Mitch McConnell and Steve Mnuchin out today saying that this may be the last bill that's necessary to deal with the pandemic. There's already a resurgence of deficit concerns among Republicans. There's Democrats are certainly going to be pushing for that. Now, Republicans do want to have that liability relief. They're dangling that out there as a trade-off for state and local aid, which is the one big, governmental relief program that was left out of this bill. So we could see something come together. I just went into a Problem Solvers, is a group of, moderate House members from both parties saying they're going to try to forge that compromise next year. So it's on the table. It just remains to be seen whether it will get done.
Now, negotiators couldn't bridge the gap on things like the liability shield for corporations, but there were things that did get in here, for example, aid to airlines. And I'm just curious, will other industry groups be disappointed that they weren't also included?
I think the big one there is restaurants. We do see $15 billion for entertainment venues, movie theaters, which have been hit hard by the pandemic. And as you mentioned, airlines, they're getting $15 billion. These are two sectors of the economy that are hurt very much by the inability of people to congregate in tight spaces. The other one is restaurants. There was a restaurant bill proposed that's a top priority for Chuck Schumer, the Senate Minority Leader. That's not in here, and he's vowed to come back and revisit the issue. So, again, I think we're going to see transportation being very much prioritized by the Biden administration. Restaurants may be another group that's up for relief next year.
Eric, thank you for keeping us completely up to date with everything. Bloomberg's Eric Wasson, thank you again for joining. Coming up, Tesla tumbling on its first day in the S&P 500. A bigger picture at the EV maker next. This is Bloomberg. Tesla shares fell 6.5% on its first day in the S&P 500. Now, Tesla had gained 731% this year through Friday, making it the biggest company ever to be added to the benchmark. Joining us now is Jay Jacobs of Global X ETFs. The largest position in Global X's Drive ETF is Tesla. It's about a 4.5% stake in that Drive ETF. So, Jay, has Tesla now seen to the critics, let's say, it's obviously fallen today, but it's made its debut in the S&P 500 and it's raised a boatload of capital?
Yeah, well, this day's been a long time coming. Tesla's been around for over 10 years, and it finally gets its due in the S&P 500. I think the challenge facing a lot of investors is this first 600 billion of its growth has already happened. The S&P 500 is really coming in pretty late into Tesla's growth cycle in the grand scheme of things. We think this is kind of one of the challenges of large, broad market cap weighted indexes, is they tend to buy the winners of the past rather than capturing them through the early stages of their growth.
Well, that's just it. I mean, the shares have skyrocketed more than 8-fold this year. I mean, that's on a par with some of the vaccine stocks, for example. Is that it now? Is today's 6.5% drop the beginning of the sort of, reality-based phase of trading for Tesla?
Well, it's difficult to say. I mean, when you look at the broader electric vehicle market, only about 2.5% of cars being sold today are electric. So clearly there's still, 97.5% of the market left to go, basically over 80 million cars per year that can go electric. So this isn't a theme that's over by any stretch, but we're certainly looking beyond just Tesla at some of the other electric car manufacturers, parts suppliers, commodity producers creating things like lithium and battery technology that play into this whole ecosystem as electric vehicles really start to displace internal combustion engines.
That said, I mean, shares, are very close to $700. We're at $690 and change now. That's $315 above the consensus analyst estimate. What are those bears missing?
Well, they're missing that this is probably one of the biggest disruptive opportunities to happen in a decade or perhaps even a generation. If you look at how much disruption we've had just over the last 30 years in the shift to communications, remote work, the rise of the internet, the rise of mobile communications, we've seen a lot of sectors already be disrupted. The one that hasn't really been disrupted yet is transportation. The global automobile industry is a $2 trillion industry. Tesla goes probably far beyond that if you include space, you include solar, you include some of the other aspects of that business. So this is a multi-trillion-dollar opportunity ahead that Tesla probably won't be the only winner in, but we see it as just such a massive market that is still, really stuck in some old ways still.
Now, it's expected to make about 500,000 cars this year, and yes, there is, that target of 20 million per year, but that's 7 to 10 years away still. And, you would have to imagine that it would have to dominate a burgeoning EV industry in the United States for it to justify this valuation. Will all those things combine to make Tesla the winner, or by then, will some of the 8 OEMs that make up Tesla's market cap right now, will they have caught up a little bit?
Right now, there really isn't much of competition. When you just compare like vehicles on a spec per spec basis, no one's really coming to Tesla yet. The challenge is, can Tesla continue to go down market into more mass market cars? That's how you're going to get to 20 million units. It's not competing with the BMW, it's competing with the Toyota Camry. Once they can do that, the world is their oyster. They could really start to take over the entire vehicle market going forward. But we know that there's heavy competition coming in. The established players, while maybe behind on battery technology, have very good operations and very powerful manufacturing apparatuses behind them. So once they really lean in, which we think is still probably 3 or 4 years away, it's very possible that Tesla will have built up too much of a lead to really be surmounted.
Part of its plan also is to, produce a lot in China. How crucial is it to Elon Musk that the President-elect Joe Biden and his incoming staff, that relationship with China is constructive? Or can Elon Musk carry out his ambition in China even if the administration takes a somewhat hard stance regarding China?
Well, it's a two-way street. China is the biggest automobile market in the world. So we not only need support from the Joe Biden administration for dealing in China, but Elon Musk also needs support from the Xi Jinping administration to be building in China, because they have their own electric vehicle manufacturers as well. So if they don't want Tesla in their backyard, they don't have to have it. So far, it looks like a pretty amicable relationship, and the Chinese are happy to have Tesla producing in the country. But that is certainly a risk for Tesla going forward.
At what price, Jay, would you start to consider maybe downsizing your position a little bit in the Drive ETF? Right now, as I say, it's about 4.5%, and it's almost double the next largest position in the ETF.
Well, that's just it. So we market cap weight our indexes, so we're happy to keep owning Tesla as it continues to grow. But 95% of our fund is invested in other things. And so we think that there's a lot of opportunity looking beyond Tesla, other electric vehicle manufacturers that have recently IPO'd, autonomous vehicle makers. A lot of the commodity producers in the lithium space are creating the key element going into batteries. So we really advocate for owning the entire ecosystem. Tesla, of course, is a huge part of that, if not the biggest part of it. But we think you're still missing 95% of the electric vehicle world if you're just owning Tesla.
Jay, how much is Elon Musk exposed to key man risk? Is there a danger that if Elon Musk were to, change his priorities, let's say, or become less involved with Tesla for some reason, that the stock wouldn't be performing like this?
I think a big part of Tesla, and clearly in its valuation, is based off of its future growth. And a lot of that is attributable to Elon Musk and the vision that he's created for a world of electric vehicles, for a world of potentially space travel, a world of solar, so creating an entire electrified transportation system. So he's absolutely a key part of that story. Without him, clearly he'd have to pick an incredible successor to paint a similar vision. And there's not a lot of Elon Musks in the world, so I hope that doesn't come to bear.
Jay, I have to ask you about the move to Texas. It obviously caused a lot of ripples, and I'm curious, will other companies now be more inclined to make the move, given that Elon Musk has announced this move? Well, what does it mean for the future of Tesla?
Well, I don't know how much it means for the future of Tesla. I mean, it means a lot for the future of the United States when you see companies moving around. We've seen a lot of financial firms look at moving to Florida. We've seen a lot of tech firms looking at moving to Texas. The reality is, with the rise of remote work, the fact that we can use video conference to communicate, that we can use chat functions anywhere, means that you can start to play states off each other more. Maybe not every financial firm has to be in New York and around the block from each other. Maybe every tech firm doesn't have to be on Page Mill Road. You can be anywhere and still have innovation and collaboration and execution. And clearly, if Elon Musk, as being the visionary he is moving to Texas, that might give other CEOs confidence to relocate as well.
And finally, Jay, as I said at the beginning, a boatload of capital to play with now. Should Elon Musk prioritize this capital in tranches? How should he spread it out?
Well, they just did another offering to raise more money at these valuations. So clearly they're looking at their own valuations and saying this is a good time to raise more money. I think if they can get money cheaply, which they can right now, it's always a good time because they're going to have to be building tons and tons of infrastructure for the various gigafactories they're building around the world, for various auto manufacturing they're building around the world. They just need lots and lots of capital to be able to scale to that 20 million number you were mentioning earlier. So anytime they can raise capital is a good time.
Jay Jacobs of Global X ETF, thank you for joining. Coming up just a few days ahead of the Christmas holiday, and at least one Amazon facility is closed due to a COVID-19 spike among workers. Details next. And later, we talk to the president of Peloton, William Lynch, on the company's latest acquisition of fitness equipment giant Precor. It's all part of the company's strategy to meet demand. This is Bloomberg.
We have seen a ton of growth. No one would wish the global pandemic on anybody, but it's been tailwind for our business as people are home. Huge growth numbers. And so keeping up with that growth, which has been a moving target, has been a big company priority. And so whether it's the investments we've made in Taiwan before this, we've been investing for years now in growing the supply chain. This is one element of that strategy.
Well, the holiday shopping rush is on, but a major Amazon sorting facility on the East Coast is now closed until at least December 26th after a COVID-19 spike. Bloomberg's Matt Day joins me now with more. And Matt, this facility is in New Jersey. Can you give us some more details?
Yeah, that's right. So this is a facility in Robbinsville, New Jersey. In Amazon parlance, it's called a sortation center. And that means it basically takes, packaged goods and routes them to, a USPS facility for what the industry calls last mile delivery, just sort of packaging things by zip codes and sending them out for that final trip to your doorstep.
When they say a spike in COVID-19 cases, do we have any idea what that means, how many it would take in order to close a sortation plant like this, and how many people work there?
We don't know how many people are infected. The state health department has said they're working with Amazon on this, but they haven't released further details to us. Amazon hasn't commented on it. We do know it's likely to be severe, only because Amazon's preference throughout the pandemic has been to keep facilities open essentially at any cost, unless there's a state order in the rare closures, or perhaps in this case, just the inability to manage the place because of a rising number of cases. But no, we don't have a precise figure. And typically, these facilities, it's a few hundred people. It's not their largest class where you can, see thousands at work. This is a degree smaller than that.
We have a number of 20,000 when it comes to Amazon's COVID cases more broadly. Now, that may not be up to date, but it sounds like a lot of people. But can you put it into the context of Amazon's entire labor force and, whether it is actually a lot for one company to experience?
Sure. So it's a little complicated about the fact that, Amazon over that period where they described the 20,000 or so cases they had, they employed 1.3 something million people in the U.S. Now, Amazon says that's a manufacturing rate below, what you'd see in the wider communities where they operate. Some people who study statistics and disease modeling say that we need to know more. So I think it's definitely commensurate with their size as an employer, right? 20,000 seems like a lot, and Amazon, the second largest U.S. employer, has definitely had their share of cases, but sort of comparing them is very difficult given that not a whole lot of other companies have released this kind of data, and we just don't know a whole lot about the granular level of it.
And we have an Amazon spokesperson statement just on the screen there. Matt, this particular facility that's closed now in New Jersey, where does it service, and will it affect people receiving, holiday items?
So Amazon says no. They say they don't expect any delivery fallout from this. We know it serves primarily, the Mid-Atlantic, mostly the Philadelphia area and central Jersey around Trenton. But again, Amazon is telling us they don't anticipate any impact so far. We do know that this is a facility next to a much larger warehouse in central New Jersey, and it's sort of designed to handle runoff. So that definitely backs up a little bit of Amazon's statement that it should be okay.
And Matt, I do want to ask you where the situation is with unions right now. We know that unions have been quite active in trying to speak with Amazon on various issues. Can you give us an update on where they stand?
Yes, there's a union drive underway at an Amazon warehouse in Bessemer, Alabama. Right now, Amazon, at this very moment, Amazon's lawyers and the union's lawyers are arguing over the terms of a potential union vote. This process could very well drag on for more months, but I think it's probably safe to say we'll get a pretty unprecedented for Amazon unionization vote up or down next year sometime. All
right, Matt, thank you so much for joining us today and for breaking those stories on Amazon consistently and constantly. A story today of a sortation plant in New Jersey closing because of a spike in coronavirus cases. And of course, last week, a wonderful feature about Amazon and the road to middle class status in America. Well, coming up, as we approach the end of 2020, longtime investor Vonnie Nada of Acme Capital gives us his take on the winners and losers this year. And we're also going to peer into his crystal ball for 2021. This is Bloomberg. This is Bloomberg Technology. I'm Vonnie Quinn in New York, in for Emily Chang. Well, despite the economic crisis and human tragedy caused by COVID-19, the stock market was on fire in 2020. A chorus of tech startups, Airbnb, DoorDash, Snowflake, well, they all went public with sky-high valuations. Is it a sign that investors have been ignoring the pain of the pandemic and betting on a permanent shift in the structure of the labor force and of the economy? Let's ask Vonnie Nada, co-founder and partner at Acme Capital. He's also the co-founder of GGV Capital. So you've had an amazing year, Vonnie. Just take us through some of the highlights of your year. It feels like you were involved in all of the successful IPOs this year.
Thanks, Vonnie. Yes, it's been a fantastic year at Acme. I think it's been a fantastic year for technology in general. I think many of us still have a little bit of survivor's guilt where we feel like everywhere around us, all the traditional companies, traditional businesses are floundering. People are losing their jobs, while in tech, we've been booming. Tech has created an environment where every month is like a dog year for companies. The last 5 months of what's been happening in the world has been like 5 years of technology adoption. I think the best illustration is that of my mother-in-law, my 82-year-old mother-in-law now ordering food on Instacart to be delivered to her home because of COVID. So that's the environment I think a lot of people in technology are feeling today.
Right, and it was a very quick change, and people who never thought that they would, modify their behaviours found that they were well able to modify their behaviours because many of these technologies were actually relatively simple to use. So, Haney, you're on the board of DraftKings. The Airbnb investment that you were involved in obviously was a huge success. Robinhood, Zoom. There are so many that have already sort of made it, if you like. But will those behaviors continue on when life returns to something akin to what used to be normal?
Well, I think the next normal is going to continue to adopt technology. It may not be at the pace that we've seen for the last 9 months or so, but I think technology is here to stay. People have learned how to use it. They've learned that their mobile phone is their next best friend. This is how they stay in touch with family and friends, and this is how they order food and basically commerce. And so I think it's here to stay. Now, it's not going to be at the same rate as it has been for the last 9 months, but it's going to continue. So I think you're going to see a lot of momentum shifting as well. I think people are reprioritizing how they work, way they work. I don't think we're all going to end up going back to the office the day that we get the vaccine. I think there's going to be a process where life may be a little bit more balanced.
How many of the companies in your portfolio will come out the other side unharmed? And I'm thinking not of the ones we've already mentioned, but companies like, for example, Rent the Runway.
Sure. So look, I think you talked a little bit about what's been happening in technology and the liquidity that we're seeing. I think a number of companies are seeing a lot of money being thrown at them by growth equity investors, by the public markets, because technology has been one of the few places that you can invest. So even the ones that are struggling have a lot of capital to survive the storm, and they'll come back on the other side. In terms of what's been happening on the liquidity side of venture investing is that SPACs are here. I call it the SPAC attack. SPACs are here to stay. For 3 or 4 years ago, they were the backwaters of liquidity, but today they are almost front and center. If you're not a big tech company, meaning you're a $10 billion, $20 billion company, it's been very difficult for you to find a way to go public. You have to have scale and size in order for Goldman Sachs or Morgan Stanley or any other big investment banks to take you public. SPACs have really kind of changed the way we think about it. It's kind of gone back to I started my career in the 90s, where you had the four horsemen, Robinson, Stevens, H&Q, and others that would take small and medium-sized tech companies public. And that was the way that you raised, your $50 to $100 million funding round to continue to grow your business. Well, the last 10 years, that's all kind of gone to growth investors. Mm-hmm. Now you're seeing SPACs come back and take place of that, offering better valuations, more liquidity, and frankly, just much more interesting environments for the smaller smaller tech companies.
Sure, and that's what people who are fans of SPACs say, right? They continually suggest that it's much better for these private companies to be attached to a good sponsor who can lead them through the IPO process and get them there faster. But do you have any concerns that there are too many now? There are too many funds looking for targets. The SoftBank one just announced today. Are the targets out there, and will all of these SPACs succeed?
So, great question. This has been my concern for the last few months. However, every single one that I've seen that it's engaged with our companies right now, a number of our companies are under engagement with SPACs to go public in the first quarter of next year. Hopefully the market holds up. Now, the issue that you're seeing that I've seen so far is that most of the SPACs that I've been involved with or I've seen around us have been high quality sponsors. These are people that have been in the technology business for a long time, or operating business for a long time, and they're actually truly adding value to the portfolio companies. When I start to get worried, it's going to be the lower quality sponsors trying to go after these companies. If you take a look at how the IPO markets open and close, the windows open and close based on the quality of the IPOs that are coming out. So if we see a deterioration in the quality of SPACs, I think the window will shut on SPACs for a while until you see higher quality names come back. So that's something to keep your eye on in terms of the quality of the SPACs, how often, how many of them stay above issue price, how well they do in the PIPE process, how well they do in the public market process once they go public. That, I think, will be a determiner of whether or not SPACs are here to stay or if they're going to be more consistent than the IPO.
Well, we will definitely keep in touch with you as we progress throughout the months to come and see exactly what happens with all of those funds raised. Acme Capital co-founder and partner Haney Nada, thank you for joining us. One of the most watched companies of the year, Peloton, made some M&A news Monday. It plans to acquire Precor, one of the largest global providers of fitness equipment, for $420 million. It's meant to help meet the demand in the US. Quick Take chief correspondent Jason Kelly spoke to Peloton president William Lynch about the deal.
And this is a big deal for us. It's 800 employees, $420 million purchase price. So we've been planning a lot, but there's a lot of things to be planned. We have no plans to change the Precor branding. They've got a great brand in their commercial channels. We will plan over time to bring the Peloton experience into that fitness equipment with our award-winning instructors and software. But we're going to be deliberate there and make sure that overall experience, that software, content, hardware experience makes sense. And so we're working through that now, but it has us excited.
And so what does this do in terms of your roadmap, sort of the Peloton roadmap that's been laid out? I know you guys have talked about things like a rower, and obviously you have bifurcated both the tread and the bike and announced that earlier this year. What does it mean for the product roadmap?
It allows us to move even faster. Part of this is their R&D and fitness equipment we think is arguably the best in the industry. They've got 100 people, Jason, focused on R&D, that some of whom have decades of experience in building what we call tier 1 fitness equipment. And so if anything, it's going to allow us to go faster. And as I mentioned earlier, was a big part. The people were overall a big part of this deal. We really like the people there and think they're very talented.
And so, William, tell me about the supply chain and sort of what you've experienced during this COVID time. Demand has been off the charts. That is reflected in your stock price, to say the least. But you also do have people out there who want a Peloton and are, having to wait weeks, if not months, to get it. How much was that a driver for this deal?
Definitely, as we've been investing in scaling our manufacturing, Jason, and certainly this is an area where Precor is really strong. We have seen a ton of growth. No one would wish the global pandemic on anybody, but it's been tailwind for our business as people are home. Huge growth numbers. And so keeping up with that growth, which has been a moving target, has been a big company priority. And so whether it's the investments we've made in Taiwan before this, we've been investing for years now in growing the supply chain. This is one element of that strategy.
And so when you think about the manufacturing, sort of onshoring more of that, how does the manufacturing mix change? What's sort of the net effect of that in terms of either the cycle of getting things produced or the mix of where things are produced?
It allows us to get bikes and treads faster to U.S. consumers. If you have a supply chain and manufacturing footprint in the trading area in which you're selling, it's super helpful, especially with some of this equipment's heavy. You've got our treadmill; it's over 300 pounds, and so shipping that from Asia, it takes time, especially in this kind of COVID disruptive environment. So it gives us more flexibility. We will continue to produce the majority of our products out of our Asian facilities. We've worked hard to build incredible capabilities there. And so this is it's about growth, helping with that growth. And so there's no mixed target right now.
And as you look across the landscape, it feels like the fitness world, to say the least, is turbulent, a little bit upside down. Boutiques closed, some permanently, some for long stretches, and we don't know whether they're going to come back. How do you look forward into 21, given what you've seen in 2020 in terms of your growth rate and sort of where you see the business going?
We've made no secret that we expect to continue to grow at a really rapid pace. We like people working out. We've said that as a company. A lot of us have taken boutique fitness and sort of came out of it. John Foley, our founder, started the company largely because he was such a boutique fitness enthusiast. And so, we don't take any solace in that, but what it has done is created huge demand for our product. We believe as long as we offer a better experience at home at a better value, which we think Peloton does, that we'll continue to see connected fitness as a secular shift from gyms and other places into the home. And so that's certainly reflected in our growth rates, and we expect that to continue for the foreseeable future.
And in terms of future acquisitions, that sort of thing, this was a big one in many cases. Is there more to be done? Is there more to be bought out there, do you think? Is there more consolidation coming?
We think so. Yeah, we're the leader in connected fitness, and we feel like in order to continue to lead, we have to innovate. We've continued to try to add more utility for our members. For just in the last week, we've announced Pilates is a new content type. So as part of your membership, you're now getting Pilates. We launched things during COVID like Family Fit Fun, so fit family fun for the whole family, stretching and workouts. We've added new software, and so you will see us continue to innovate. And when it makes sense, we will purchase companies, whether it's technology tuck-ins, whether it's teams we like, all in service of continuing to make that membership more and more valuable and higher utility.
And that was Peloton President William Lynch. Still ahead, at least 200 organizations from government agencies to private sector companies were hacked as part of a suspected Russian cyber attack. We discussed with a leading expert in the area, Teresa Payton of Fortalice Solutions. This is Bloomberg.
It is very serious. We don't know the depth of it yet. We have to spend a lot of time and analyze it. But we are vulnerable in ways we never imagined. We've spent billions of dollars, obviously with limited success in protecting ourselves. What's at risk is literally the defense of this country, the national security, and we've got to take it seriously.
An ominous assessment there from Illinois Senator Dick Durbin after suspected Russian hackers breached internal networks of many U.S. government agencies and private companies. With more on our vulnerabilities and what officials are finding out about the hacks, we have Teresa Payton joining us. She is CEO of Fortalice Solutions. Teresa, is this the tip of an iceberg, or have we pretty much figured out what's going on?
We have not figured out everything that's going on, and so we know a lot, but the forensics and the investigation continues. We have not identified all of the victims at this point in the full ecosystem. And so, for example, we know that the red team tools of FireEye were taken. FireEye has put a bulletin of what different organizations can do to protect themselves from an attack. Counter surveillance measures have to be put in place. Then we know that SolarWinds had the supply chain attack where the malware was inserted into their product, which was then downloaded. Mm-hmm. But now we're also learning as part of the forensics investigation that there could potentially be other ways that attackers moved from SolarWinds customers to non-SolarWinds customers. This is still very early in the investigation, so a lot still has to be confirmed, and a lot of the countermeasures will be developing over the weeks and months to come.
Well, and Teresa, as often happens with these things, we're finding out that a SolarWinds advisor did warn of lax security a long time ago, several years, in fact, before this hack. How do we prevent this from happening in the future?
Well, one of the things that this needs to be a stark wake-up call for is just spending money on products and hiring people is not going to be enough. It requires very creative thinking and designs of systems. So, for example, the way this attack worked is the attackers were able to create for themselves something we refer to in the industry as God access or God door, basically the most elevated privileges you can imagine to give themselves a digital passport. They could go anywhere they want, and software products and security products weren't stopping the attackers from moving laterally. So one of the things that has to happen is better segmentation, both physically and logically, of systems, of data, of access, so that it makes it harder for attackers to just present this digital passport, if you will, and go any place they want to. There needs to be something built into our design that allows us to have kill switches and shields up decision-making processes so that when something is an anomaly like this, that we can actually go shields up, flip a kill switch, still have things operating while we figure out what's going on in an investigation. Right now, doing something like that is very extreme.
Yeah, I mean, Teresa, this is a March attack, and right after that, everybody went remote, and everything went to computing, right, to computing power. How deep into our deepest secrets might these perpetrators be?
Not only are they probably very deep into the secrets of, they're on the unclassified systems in government, but you and I both know that just a normal course of doing business, a lot of information is passed back and forth between businesses and departments and agencies and the military. And we used to say at the White House that pieces of the puzzle on the unclassified side a lot of times lead to kind of the bigger things that are discussed on the classified side. So we have to assume that our critical infrastructure, our vulnerabilities about that, our conversations around trade, that those have all been at some point or time been read, been looked at, been intercepted. Now the question is, why? What was the motive? What was the purpose? Was this purely I need to do intelligence, so it was a digital intelligence move? Was this to steal intellectual property? Or was it to lie in wait at some future point to use this as a bargaining chip with the United States, with other countries, because this is not just a U.S. hack? We don't know yet what the final motive was for these attackers.
Or is indeed. Teresa, thank you. We will check in with you again very soon. This is going nowhere. Teresa Payton of Fort Alice Solutions joining us. Still ahead, another startup going public via a SPAC just 10 days before the end of 2020. We'll hear from one of Opendoor's key investors next. This is Bloomberg. Online real estate firm Opendoor made its trading debut Monday through a merger with a SPAC, marking the end of a roller coaster year for the company. Although its prospects looked pretty dim during the early months of the COVID-19 pandemic, a rally in the housing market has boosted real estate technology firms like Opendoor. Joining us now is Glenn Solomon, managing partner at GGV Capital, which is an investor in Opendoor. So first, congratulations. This is partially an exit, so well done, Glenn. I'm sure you're pleased. At the same time,
Thanks,
the
Vonnie.
stock today rose 6%. It wasn't quite, the jump out of the gate that we've seen from some of your other investments this year. I'm curious if you're disappointed a little bit?
No, not at all. Opendoor is a SPAC. It went public as a SPAC as opposed to an IPO. So it would have been unexpected had it had a big first day of trading. In fact, the company's had quite a run up leading up to this first day of officially trading as Opendoor. So very happy with the capital raise that came along with the SPAC, in addition to the PIPE that was raised as well, and just excited for the company to be public now and have a public security.
What was the attraction of the SPAC and the sponsor in particular? Why did the founders decide to tie themselves to going public in this particular way?
Vonnie, it's a good question. I think for Opendoor, this transaction made a lot of sense. Remember, whether you go public through a SPAC, an IPO, a direct listing, on day two, you're just a public company. And so the most important thing here was speed to get to the finish line, raise enough capital so that the transaction is worthwhile, and also have the opportunity to tell your story to investors and build a book of investors that you want to have in your company. And the SPAC gave Opendoor the opportunity to solve for all those pieces, and so it was a good transaction for the company.
Now, you've had a phenomenal year. If you include Opendoor, you've had 7 completed IPOs: Wish, Airbnb, BigCommerce, Xpeng, Agora, and DraftKings. And there is one pending. It's going to be a very interesting one. It's the Max Levchin Affirm Payments IPO. Can you tell us how you anticipate that will go, and if it will indeed cross the Bloomberg this year?
Well, yes, we feel very lucky at GGV Capital to be involved with so many great companies, and a lot of them, as you mentioned, have tapped the public market this year. Affirm, another great company, and Max Levchin, an incredible entrepreneur. We're very excited about the future of Affirm. I can't speak specifically to the timeline of their public offering, but I do think that the business that they're in is quite attractive. Their filings are public, and you can see that they've grown quite a bit. So we're very excited about the prospects for Affirm, as well as the other companies that have gone public this year.
Glenn, no one was really expecting this year to pan out the way it did. It's been extremely successful, even for some companies that really were extraordinarily shocked at the beginning of this pandemic. such as Airbnb. What does next year hold, and what's the next frontier now that we've gotten, through this pandemic to a certain extent?
Yeah, the pandemic has definitely accelerated a digital transformation that's been occurring across a lot of industries. You take Opendoor as an example, and people have been excited about the Opendoor model for quite some time. It promises simplicity, speed, certainty. Those are things that consumers want. But this year, one of the reasons that Opendoor has seen good growth in its business is it's also a secure way to transact. And if you look at the industry, the housing industry, as a proxy for others during COVID, you've seen great growth because people are moving from urban centers to suburban centers. They want more space to be able to work from home, which is definitely something that I don't think will switch off when the pandemic, comes to an end. And you've got a supply-demand imbalance in the housing market. So I think Opendoor is a big beneficiary. And my expectation is for Opendoor, these trends don't end when COVID ends. And I think you'll see the same in a lot of other industries like travel, Airbnb, et cetera.
Well, Glenn, we will see if those predictions pan out. We'll have you back. GTV Capital Managing Partner Glenn Solomon, thanks for joining us. Opendoor up 6% in its debut, OPEN the ticker. That does it for this edition of Bloomberg Technology.